With an inflation rate that is nearing 10%, all eyes were on the Federal Reserve and the announcement of its plan to try to push it down.
Against this backdrop, today the FOMC raised its policy interest rate by 0.75 percentage point and anticipates that ongoing increases in the target range for the federal funds rate will be appropriate.
The increase was not unexpected, and the stock markets, which have been calling for aggressive Fed action, rose sharply on the news, bolstered also by the Fed chairman's contention that the country was not in a recession.
It doesn't seem that the U.S. economy is in recession right now.
That, along with the fact that he left the door open about the size of any rate move in September.
As the stance of monetary policy tightens further, it likely will become appropriate to slow the pace of increases while we assess how our cumulative policy adjustments are affecting the economy and inflation.
The rate increase is going to directly affect this D.C. smokehouse. Its owner, Mel HINES' plans for expansion had already been impacted by rising inflation.
Obtaining wood, obtaining cement really went through price adjustments. So my contractor was conscious of it, but of course, it rolls down the hill. So it has to come to me as well. So, you make adjustments to the project plans, you make adjustments to how you operate.
And so the price increases are passed on to the customer, who's now expecting a better product for the higher price.
I mean, we check prices. I mean, if we walk out of here, satisfied with the food we ate, we don't care about prices. But, if we're not satisfied with the food, we'll probably won't be coming back for sure.
Economists maintain the rate hike was the only tool the Fed has to counter inflation in the long term. But in the short term, the medicine's going to have a bitter taste. Mike Hanna, Al Jazeera, Washington.